Hi, welcome to the Market Alert for Friday the 28th of October 2016. So yesterday's trades here are for the 27th. So we started off with a potential sell signal. We see this actually filled. And then we wait for the building figures, pending home sales. They came out at 1.5. They came out stronger than forecast, but it's only a medium impact news item. And as I said before, medium impacts are not too much of an issue at all. And there's a bigger problem in the market yesterday than worrying about pending home sales, which I'm going to come to in just a moment. So the figure came out better than forecast, and this sent the market down. Well, it wasn't that sent the market down, but I'll come to that in a moment. So we actually break through the scalp and the psychological level here of 18,200. As at this point you cancel the stop, and then you can move the stop to break even. The market then continues lower. And then as it moves lower, you can just keep putting in the 50% above the lower highs. And if the range of the bar is greater than the previous bar, then leave that alone. And then eventually you see we've got a potential buy signal there. Alternatively, what you can do is this, because you know that the psychological levels are going to create some sort of support. There's no doubt about that. So you can come from here, and as soon as the market gets down towards the levels down here, you can see you're sitting on 70 odd points of profit. You know that at the moment they want the market back up, irrespective of what's going on in the background. Again, I'll come to that in just a second. That they're going to want the market back up, and sure enough, we then get the market turning around and moving back to the upside. And it took until this bar to actually create the profit in this one. And again, if you see the psychological line where the market stopped, if we look at that one first, we've got the entry price here to the psychological line, and you'll see there's 48 points. But if you choose to actually tuck underneath the rising lows, you can see there we've got 18,232, and again, if just for quick ballpark figure there, you've got 31 points with this. So I sent a note out saying, well, that was a good enough, and for the first part of the session, the market then traded sideways. This signal is not valid, and I'll show you why in the reloaded chart, because at this point I'm just going to wind back the live chart here. You'll see the actual signal. It will turn up. This is the actual bar here, but it wasn't filled, and in fact the market moved lower, put in a sell signal which wasn't filled either, and then we went with a buy signal which didn't happen, and then we had another sell signal which was filled. At this point I wasn't trading, and I'd just come into the study, turned everything off, but you'll see from here that the market continued lower there. It wouldn't have been a trade that I'd done had I been here, because having had the two good trades in the earlier part of the session, as I said in my email, then it was time to stand aside. And you never know if they're going to try and bring the market back up again, as they did in the earlier part. Now in the daily charts, we've got this sideways move still. 18,263 is creating the resistance. But what caused the market to move lower yesterday? Well, what caused the market to move lower yesterday is the 30-year yield in the bonds. The debt market is the biggest market. It is worth trillions thanks to the QE printing. And we have a problem, Houston. I'll just show you this in my old piece of software that I still use. The 30-year yield has been increasing since July. It's gone from 2% all the way up to its current level of 2.6. Doesn't seem like a lot, but it is when you're holding trillions worth of debt. This is going to make all central banks, or create and put them in a situation where they're going to have to increase interest rates, and you can imagine the knock-on effect of that. Nobody wants the cheap bonds anymore. They want more of a return for the risk that they're actually going to be offering. Again, another key here, that everything that the Federal Reserve have done, Bank of England, Draghi and co, is failing. The interest rate yield on the longer term debt is increasing. That is not good news at all. Not good news at all. So that's why the stock market was lower yesterday, but eventually they were able to bring the market back again. So the daily chart, you can see that yesterday was it's quite a narrow range compared to the previous day, and again you've got some selling in there as well. News-wise today, what have we got? I tell you what is interesting. With the all of the central bankers seem to have cleared off at the moment, giving no help to Clinton or to Trump. Actually, it's like we'll stay out of it for the time being because we don't want to look too political. So, is the only thing I can deduce by their absence. I mean, 1 minute they're there every day. It's like the Federal Reserve reality show, and the next minute they've gone. So, no sign of them at the moment. And what have we got? 3 p.m. revised UOM consumer sentiment. That's going to be out. Again, you're not going to worry too much about that one. Let's see how the volatility is in the pre-market session this morning as well. It is Friday, going into the weekend. And also, we've got another week yet before we get the US elections. Just one more week of this sideways move, but at the moment I'm quite happy with it because it's producing some nice signals. The volatility is just perfect, so let's long may it continue throughout next week. What else have we got? We've got the implied volatility, of course, 1343, up yesterday with the market selling off quickly but then recovering, so a bit of a spike up in this for yesterday. So that's it. Let's keep an eye on the bond market. Certainly going to be interesting, but this is if the bond market goes, i.e. the bubble bursts in that one, then we've got a major global problem because the rates will accelerate and the central bankers' arms will be forced up their backs and they will have to increase interest rates. Right, that's it for now. I will see you in Monday's Market Alert. Have a great weekend. As ever, thanks for your support, also for watching. See you in the next one.